My name is Erin Bellissimo, and I'm the Managing Director of Notre Dame Institute for Global Investing, and formerly the co-founder of the Halpern Center at Columbia Business School, where Professor Bruce Greenwald and I collaborated for nearly 9 years. Professor Greenwald has been the leading academic voice on value investing and has also been involved in many commercial investing enterprises. Bruce is unique because he relates to both students and practitioners with his ability to bridge the theory of investing with the practice of investing. So with the recent release of Barnes & Noble's paperback edition of Value Investing, we thought it would be a great time to have a conversation on the book. Bruce, it's great to see you again.
Erin, it's always great to see
you. Well, it has been 20 years since the first edition of Value Investing was published. And before we get into some of the changes and reasons for the new edition, can we just kind of start basically with the meaning of value investing to you? I know Howard Marks, a noted value investor, published a memo earlier this year entitled Something in Value, where he talks about growth and value and how his son Andrew's, as a growth investor, has impacted his thinking on this. Is it fair to categorize value investors from growth investors today? Are they mutually exclusive? How do you think about that?
Oh, I think that today that distinction, and it's a distinction again that Buffett rejected explicitly many years ago, has less valence and less importance than it's ever had. I mean, if I think of what value investing really is, I think there are three principles that you cannot get away from. So the first is you've got to look intelligently for opportunities. You're not going to look at every possible investment and every possible security. The second thing is that you really have to, and this is the crucial element, you have to know what you're buying. That you have to know the value of what you're paying for. Not perfectly, but as best you can. And that is really Ben Graham's distinction between investing and speculating. And then I think the third thing, which I hope we'll talk about a little bit at the end, is you have to have the discipline to wait for bargains. You can't get bored and just take off. So at the heart of this is a superior valuation approach. And that means taking a long-term point of view and understanding when you can value things and when you can't. Now, there's nothing about what we've talked about that excludes investing in growth. It's just that when you invest in growth, you have to know what you're buying. So the first thing is you have to know when growth adds value. If growth doesn't add value, don't worry about it. And growth only adds value in franchise businesses, where companies earn more than the cost of capital on their overall investments and their growth investments. Second thing is, it better be a stable industry. If this is an industry in the process of formation, so it was like search when Inktomé and other companies looked like they were going to be dominant, it's not stable enough to know what the future looks like, and you're not going to be able to invest successfully in growth. And then you have to have a technology that enables you to figure out what is this growth worth. So I think the distinction is not one between growth and value, but between a growth approach to growth and a value approach to growth.
Excellent. And I hope we'll get into that in more detail. And certainly it's a big part of the value investing book. But why, after 20 years, produce a second edition? Can you talk about what has changed since the first edition was published?
Let's talk about the simple things, which is that we learned a lot from students and practitioners since in the 20 years since the first edition, including people like you and Tano and Mark, who we've actually learned enough from, so we put them on the cover of the book as secondary and co-authors. But the real change that's taken place is a change in the environment. And it's reflected in the fact that a lot of traditional value investors have underperformed by 15 years or more. And that, I think, is due to underlying changes in the global economy that have made growth a much more important element in generating value. That's made franchise businesses a much bigger part of the landscape. And for that reason, I think we had to really begin to address a challenge, which was how can we put a reliable number on what growth is worth? And that's really the heart of the book.
In terms of some of the shifts, can you talk specifically about, specialization is something I've heard you talk a lot about in recent years and the importance of that. Can you talk about that as an investor and why you think that's increasingly important in today's economy and how companies?
Let me actually address that sort of indirectly. I mean, let's talk about these economic changes, because I think they're the thing that's crucial. So if you look at the history of economies since World War II, which is sort of from 1950 on, where serious investing starts to be important, the dominant trend between 1950 and 1990 is globalization. Markets are getting bigger, and as they get bigger, they get easier to enter and they become more competitive. And you see that most dramatically in automobiles, where national companies like GM, even in the United States, just go from being the most powerful of blue chips to not being, or being barely economically viable. So in that period, what happened was that as competition got more severe, returns to growth got lower and returns to overall capital investment got lower. So that when people bet on growth based on history to that date and missed this underlying trend, growth proved to be a very bad investment. And that's why value investors who wouldn't pay for growth really did so well over that particular period. That whole process has changed. The dominant changes since 1990 have been in the opposite direction. They've been towards not bigger, more competitive markets, but smaller and therefore inherently less competitive markets. The most dramatic reason for that is the shift in the global economy from manufacturing to services. Services are locally produced and consumed, and you've got local markets that are absolutely crucial. And because you have customized products, you have, even for manufacturers, geographic dimensions to their markets that are crucial and create these local environments that they can dominate. In technology, what's happened is that today you can mix and match technology. So in the old days, IBM did everything. It did the chips, it did the software, it did the hardware, it did the peripherals, and it put the system together. And managing compatibility almost made you do that. Today, what you've got is an environment where Microsoft does the operating systems and the central software. Intel does just the CPU chips, not all the chips. Oracle does the database systems. Google specializes in search. Amazon specializes in cloud computing. Adobe specializes in fonts. So you see a balkanization of these markets and niche markets. And again, niche markets are small markets that can be dominated. In those markets that are dominated, once people increasingly earn above the cost of capital, they earn more on their growth investments than they have to pay to raise the money, and growth suddenly has a lot of value. So we've gone to an environment where increasingly franchise businesses for which growth matters are the dominant part of the investment landscape. And that's what we have to adapt to. But now to get back to your question, when you invest in growth, you're implicitly dealing with the long-term future that you don't necessarily see yet. And that means, among other things, that you really have to understand industries and understanding the rate at which they're evolving. And to really understand industries, you're not going to do it with a 50 stock portfolio in a lot of different countries, in a lot of different industries. From a service perspective, you have to understand different geographies. And the only way I think people are going to do that, and this is really, I think, the first important change in the book, is you're going to have to become a specialist. You're going to have to basically become a geographic specialist and an industry specialist, or a specialist in a collection of industries. Because if you think of it in these terms, I mean, suppose I've spent my whole life doing onshore South Texas Gulf Coast oil leases, and that's all I do. and you fly in from Germany and buy an oil lease from me, who do you think made money in that transaction? So in a non-complicated environment, the person from Germany may have a chance. But once it's a complicated future that you have to understand, you're not going to have a chance as a generalist against a specialist. So yes, specialization is absolutely crucial. You don't have to be a single industry specialist, but you do have to have a handful of areas where you are the dominant competitor. And that, by the way, if you look historically, is applied to somebody as smart as Warren Buffett, that he has done better in the 4 industries, old media, consumer non-durables like Coca-Cola, insurance and banking, than he's done in other investments. So yes, specialization, especially in an environment where growth is crucial, is absolutely central to a good investment strategy.
Well, I appreciate that comment because it's directed at my Notre Dame students who all tell me they want jobs where they're generalists before they've had a long career to develop any expertise in an industry or a certain sector of the market. So thanks for that little commercial and indulging me on that.
By the way, the examples of the investors who you look at who survived the change from pre-1990 to post-1990, they are the people who specialize.
Yep. Excellent. So in terms of, in the book, I know there are some things that have been refined, and then there's some big changes, and you've already alluded to them in terms of valuing growth and franchise businesses. What are the changes that you think are most important in the second edition of value investing?
Okay, so let's start with just the 3 elements of value investing. I think we've talked about searching for, intelligently looking for opportunity. In the old days, that was the standard, cheap, unfashionable, obscure, and diseased stocks. And we know behaviorally that gave you a real advantage. I think that's not enough anymore. So we've talked very much in the book about specialization, both geographically and so on. So in terms of looking intelligently for opportunity, the big change is you're going to have to add specialization to the standard value orientation that value investors are familiar with. The heart of the book is getting a decent valuation methodology, and that's really changed very importantly. I think one of the things we learned was that we really had too narrow a view of what good valuation looked like, because when we first did this, and you were around when it happened, we looked out in the world and we saw how much better just the asset value, earnings power value technology was than a DCF technology. And we thought that was enough. And I think what we've learned is really valuation approaches have to be specialized for applications. So if you're doing event-based investing, especially in fixed income areas where the payoffs are well defined and the timing is what's uncertain, well, that's where DCFs really do a good job. And for those kinds of investors, a DCF technology is the right technology. If you are investing in competitive assets, these are non-franchise businesses, real estate, natural resources, competitive markets like automobiles, people earn the cost of capital on investment. So if you grow and you invest $100 million in growth, you earn 8%, and you have to pay 8%, which is the cost of capital of the investors, and growth has no value. So doing asset value as of today and earnings power as of today and triangulating those is the best way to do that. When you come to growth, there's a big problem with putting a value on things. That because you're talking about the far out future, the value of that far out future is hugely sensitive to the cost of capital and the growth rate. So if you look at today, probably a typical cost of capital is 6%. A growth rate might be 3%. Ultimately, you're going to be multiplying the cash flow times 1 over the difference between a cost of capital and a growth rate. That's sort of, say, $100 million times 1 over the difference between 6 and 3%. That's a 33 times multiple, 1 over 3%. If On the other hand, you're just off by 1%. You could have a cost of capital of 5 and a growth rate of 4. That's 5 minus 4, which is 1%. 1 over 1% is 100 times multiplied. If it goes in the other direction, so you've got a 7% cost of capital and a 2% growth rate, it's 1 over 7 minus 2, which is 1 over 5%, which is a 20 times multiple. It is a 5 to 1 error. And the notion that you can do more accurate calculations of growth rates and long-term cost of capital, because again, we're talking about the distant future, is just kidding yourself. So you have to do a very different approach if you're going to know what you're buying when you value growth.
Yep.
The part of that approach is, first of all, to make sure it's a franchise business.
Yeah, and can I stop you there, Bruce? Because
Sure.
that, I think, you know, a lot of people get confused on a real franchise versus a brand and a well-recognized company. Can you talk about what makes a franchise company and what a real franchise earning higher returns on invested capital is?
Okay, it's got to be.
And how do you test it as an analyst?
Okay, it's got to be barriers to entry. That is absolutely crucial. A market with no barriers to entry, for example, if you have organic growth, your sales will go up temporarily, your earnings will go up, but that's going to attract entrants, and they're going to drive your profit margins down either by, making the market more balkanized and driving up your fixed costs or driving down your prices. So if you can't keep them out, you get no benefit from organic growth. If you have cost reduction and it's a competitive market, that's going to go to the consumers. I mean, if you make higher profits temporarily, existing competitors are going to expand to take advantage of it. Entrants are going to come in to take advantage of it. And again, the benefit's going to go away. If you find a great new investment, so, you say, okay, we're going to make aluminum underwear, and it turns out to be a big success. In a competitive market, everybody is going to enter and eliminate the benefit of that. So there may be temporary growth returns and temporary benefits, but in the long run, what you have today and the value of the assets you have today and the earnings you have today is what drives things.
Yeah.
When you can prevent the process of entry, none of those arguments apply. So it is really about, and Buffett's word for this is moats. Moats and franchises are identical. And it turns out moats are not that hard to calculate. I think one of the things Buffett has been coy about is not letting people know how easy it is to calculate. So if you think about the global automobile industry, it is so big that people can be viable with 2% market share. That people buy cars every 7 to 10 years, so they don't tend to be captive. So a lot of market share changes hands. Typically about 1% will change hands a year. Well, to get to 2%, which is a viable level of entry at 1% a year, is a 2-year moat. And that's not going to stop anybody. At the other extreme, you've got Coca-Cola. In order to have the economies of scale necessary to distribute heavy product like soft drinks, you typically have to have something like 25% local market share. That's a situation where there's tremendous consumer loyalty. If you look at in contested environments, 0.2 of a share changes hands every year. So to get to 25%, it's going to take you at 0.5% every year. It's going to take you 125 years. That's an enormous moat. So the first element in this is, what's the minimum viable share somebody has to get to? For very big markets, that's going to be low. For small niche markets in geography or in product space, that's going to be large. And secondly, what does customer captivity look like? And because the current technologies tend to be user-oriented, you have to learn how to use it, so you have a lot of customer captivity. And in services, it's face-to-face with high purchase frequency. So again, you've got a lot of customer captivity. But really what you're looking for is minimum viable scale divided by annual market share change in a contested environment.
Excellent. Appreciate that. So in terms of valuing a franchise business, can you take us through, obviously the book has, a lot of new information on this. Can you split it out into the process of organic growth and some of the things?
All right. So let's just start with the fact that you're not going to be able to calculate a value. The only way you're going to invest sensibly in growth is to look at the price you're paying for the company, enterprise value or equity value, depending on how you want to do it, and ask the question, if I buy at that price, what kind of a return am I going to be getting? And that return consists essentially of 4 elements. And you've got to look at them each individually. And fortunately, the total return is a linear sum of those elements. So the first is the cash return that you get. It's just, what are the earnings, sustainable earnings as we sit there today, and how much of it are they distributing to you in cash? And that's something you can look at today. It's 2 fairly simple elements. And that's where you start. So you got a cash return. So you look at Nestle today, it's the dividend plus the buybacks. It's been about 3% a year, 3.5% a year. Second thing is that there is organic growth that creates value. And it creates value in 2 dimensions. One is growth in revenue, and the other is reduction in cost, which appears as growth in margin that doesn't get eliminated by entry. And that's where it really takes industry knowledge. What do these trajectories of revenue look like? How are they tailing off? And you can, calibrate these against global GDP growth. We know that for, items sold to rich people, demand is growing faster than items to poor people. We know certain kinds of leading edge products are going to grow faster for a long period of time and so on. But you can, if you are an industry expert, have it make a reliable long-term projection of what that revenue growth looks like. And you ought to be able to do a similar measure for margins. And then you can compare that to past history. So you've got an earnings return, a cash return, you've got an organic growth return. If that cash return is growing organically at say 4% with revenue and another 1% with margins, that's another 5%. And it's because that growth element typically is very large compared to the current earnings that you have to be able to track those things. So you have say 3.5 for Nestle. Now Nestle isn't growing all that rapidly, but margins are growing over time. It's another 3.5 in organic growth. And then of the money that they don't distribute, they reinvest it. And for every dollar they're reinvesting, the question here is how much value are they creating? So if say the earnings return is 5, they're distributing 3.5, they're reinvesting 1.5. 1/2 of that will go to support organic growth. So you got a 1% active investment. They're doing it well, but they're investing where their economy of scale and other advantages carry over. They might generate $2 of value for every dollar they invest. They might have a 16% return versus an 8% cost of capital. Well, that 1% will generate 2% growth in earnings. If they're investing it badly, which most of them do, and an example in the book is where Intel basically generates 20 cents of value for the recent investments that they've been making, that 1% is going to be worth 0.2%. So you've got cash return, organic growth, active reinvestment growth. And you can compare that to a cost of capital, which is what an investor would require to invest voluntarily in this business. And those numbers are about somewhere between 6, maybe even 5.5 and 7.5 these days. But, and this is the thing all our students forget, franchises don't last forever. So in the margin of safety and returns between that, what we've calculated, say, is an 8.5% return and say a 6.5 cost of capital, that return of 2%, or that margin of safety of 2%, has to cover the future fade rate of that franchise. And the way to assess that is, again, pretty careful. Just think about what this company is going to look like 25, 30, 40 years in the future. Is it going to continue to dominate its market? I think if you look at Tesla, the chance that it's going to dominate the electric car market 25 years from now, given the history of that market, is close to 0. But in a lot of these businesses like Nestle, you probably have a 50-year period before it's, half the franchise, half the value has gone away. That's a half. And if half the value goes away in 50 years, the rule of 72 says it's 72 divided by 50, which is about 1.4% fade rate a year. So you've got the cash return, the organic growth return, the active investment return, minus the cost of capital, and that's got to cover this fade rate. So the fade rate is the fourth element here. And almost everybody who invests in growth just forgets about the fade rate. They assume these franchises are going to be there forever. And you can think of companies where, when we look at these industries, things just don't last that long.
Could you give us some examples? And and how the fade rate came into play, maybe newspapers or some of the other industries?
Well, the classic case, of course, was, and you were there when people told me I was a subversive idiot for doing this, was, when you look 20 years ago at the newspapers, you could already see that 20 years from now, they were not going to be around and profitable as they were. You could see that was you didn't know exactly when it was going to arrive. And it arrived, I think, sooner than everybody expected. But, if it's going to be by 20 years, you're pretty sure that the franchise is going to be gone and half the value is gone. 20 into 72 is 3.6%. So if you thought newspaper returns, because they weren't growing that rapidly anymore, were like 7.6, and they were fading at 3.6, that's a 4% return. That's nobody's idea of a good return. So you've just got to understand that's one example where it's a fast fade rate. Coca-Cola is, it's been around for 100 years. It's probably going to be around for 100 years more because, people are going to buy beverages. They're going to have to be distributed. And SodaStream seems not to have destroyed the distribution properties yet. So, if that's in fact the history that reproduces itself, that's only a 0.7% fade rate. So again, it's a long-term focus that we talked about at the beginning.
And clearly the management of Coca-Cola, as people are drinking less sugary drinks, are filling those distribution pipes with other beverages that people are drinking.
Absolutely. Yeah. So the fade rate will depend on management. That's a really good point.
And what about, some of these large technology companies that have core franchises businesses? Let's take Alphabet, for example, in search. And then they have even listed on their financial statements other businesses, like other bets. I think they even call them for a long time. How do you think about the multiples that are on those companies today and how to separate the value?
Remember, multiples that are not just current earnings returns have got to be related to franchises. In new markets, nobody dominates it. Those are the definition of competitive markets. Google got into search at exactly the right time. Alta Vista had been replaced by Inktomi, and they wiped out Inktomi. And by that time, everybody was searching, and the technology had stabilized. So they were able to dominate the search business and get down a learning curve that was a stable learning curve. That business is going to continue. We know sort of how it's going to grow because it's like information advertising, and that grows about 1% to 2% faster than GDP, or it historically has, and that shouldn't change. On the other hand, there are other businesses that are not going to be that stable, and search, because people, and one of the things that they're doing is that they're specializing it for individuals. So it's very hard to keep up with them. I think that's a franchise that's going to last a long time. They're going to make a lot of money. The rest of the stuff, the smart cars and so on, that's in a competitive market. They have no particular advantage, and maybe they'll get back their investment, but the evidence so far is that they're just wasting the money. So that's an active reinvestment, which you think they're maybe producing 20 cents on the dollar. Another one that I think is much more fun is, remember, your enemy in these markets is growth. That if it's a very big market, the minimum viable scale is going to get to be much smaller. The minimum viable scale.
Hard to get economies of scale in a huge market.
And the company, I think, is Qualcomm. And Qualcomm
Mhm.
basically dominated the technology for the crucial thing in cell phones, which was the input output area. I mean, they had basically a transmission technology that everybody had to use. Now, that technology is now more than 20 years old. So the fundamental patents have expired, although they've got a lot of following patents. But that market has absolutely exploded. And people can be viable with a 3 or 4% share of that market for the software cost of developing a competitive system. And I think as that happened, you've seen Qualcomm's value erode strikingly. I think the same thing is happening to Intel. The market's gotten much bigger. And I don't think 25 years from now, CPU chips are going to look any different from memory, the way memory chips look now. That a lot of people are going to be able to do, given that the market is as big as it is. And the capacity of the chips has gotten so much bigger.
And I would guess you would say, because this is one we talked about for, I don't know, the 20 years I've known you, Apple was able to shift from the hardware to dominating the software and the apps in the App Store to to
make that difference. And the hardware was not a case where they had to invest a lot in R&D, so there were not big economies of scale there. But in software, because there's a lot of it, and especially when you can do application software and you've got a lot of customer captivity, it matters a lot. But 25 years from now, do you really think Apple is going to be a cell phone that charges 4 times as much as everybody else? I wouldn't bet on it unless they implant it in your ear and your brain.
I don't know. I think they almost have.
So far, it's been an incredible run. Yeah. I mean, they are the General Electric of that first period of the economy. I mean, General Electric survived way past their sell-by date in terms of the underlying economics. And I think Apple has shown an ability to do that. But I wouldn't bet on it if I were an investor that it was going to last for more than 25 years.
Fair enough. Well, let's shift gears a little bit then, Bruce, unless you want to talk through any of the other examples.
No, I hope that's a reasonable sample.
No, I think that's terrific. And it definitely goes to the heart of, you have to value the franchise part of the business in that growth. You can't just shove everything into a DCF, which is what we try to tell our students when you're dealing with the franchise. You have to look at the different components of the growth.
Absolutely. And you have to look at a return. You're not going to be able to look at a value. And that does create its own problem. And it's the problem with the sell decision. So that for a traditional investor, when something is fully valued, you know it's time to sell. You may wait 10% because the momentum will play out, but you know when to sell. These returns are not particularly sensitive to the underlying prices. And in fact, the proper formula on the value of the growth, it's the growth times the ratio of the intrinsic value to the market value. And since you're setting that term arbitrarily to one of the big effects of rising market value doesn't come in your calculation. So you're not going to have an accurate measure of price at which to sell. And that means that you've just got to decide what your risk tolerance is. So if you're risk averse, you're going to sell when it gets to 20 times, 22 times earnings. When you can see in your cash return almost all of what a decent return or what your cost of capital is. If you're more risky, you may ride it to 40 times earnings, where your current cash return is maybe 30 or 40% of what you're getting, or 20% of what you're getting back. But you're not going to be able to do a precise calculation there. And you talk to good franchise investors, the sell decision is the toughest one to make. And the way Buffett always made it in the past was he would never sell. Well, that didn't turn out to be a brilliant idea. So I think we changed that.
Yeah, no, definitely, because there's no clear intrinsic value that you're hitting, and then you sell. So it is definitely looking at the growth and what you think the prospects are, and if you're comfortable with whether the multiple expands or what those rates are is my guess on that sell decision.
I think that's exactly right, and it's something that is a crucial element of discipline. You've got to not get, if you're that kind of investor, you can't get excited about the fact that your money is doubled or tripled or quadrupled, and just hold on.
Yep. Well, let's shift gears just a little bit. One of the big things that I work on day to day is kind of the nature of the industry and who's coming in, who the pipeline of the next generation of investors are. And clearly, one of the criticisms in the asset management business has been the lack of diversity. And at Notre Dame, we're running programs to create a broader pipeline of talent, and are involved in organizations such as Girls Who Invest. Can you speak to investing as a career for women or underrepresented populations, or just people who come at this business with a different point of view, and how that might be a benefit? And just
Yeah, let me go back to those three fundamental, I would say, investing conditions, which is looking intelligently for operations, just having the discipline to be focused and not to want to do everything, not to want to rabbit around. Having a decent valuation technology and doing a lot of focused research in the context of that valuation technology, looking at how much value management is generating for each dollar we invested. And that last element is having the discipline to wait until you have a decent margin of safety. I think that temperament is crucially important in that last one. It's also crucially important in sell discipline and any kind of risk management. So I think one of the things that you have to concentrate on when you're looking for good investors and trying to expand the universe of investors is people who have a suitable temperament. Now, in my lifetime of teaching, I've had two kinds of students. I have had students who think they know a lot more than they do, and students who actually think they know a lot less than they do. It should be clear from a temperament point of view, students who think they know a lot more than they do are not going to have the discipline and the temperament that you need. Those students who think they know a lot more than they do are overwhelmingly men. And this is borne out by the research. And the students who tend to think they know less than they do are women. Now, not having confidence in your judgment is a big problem in investing.
Yep.
But it's a safer problem than having too much confidence in your judgment. So I would encourage women, obviously, to get involved in investment. From just mechanics of the career, the fact that it's flexible, the timing is not fixed by having really to go to many meetings. It's study that you do by yourself. I think that, as we know, women do better in academic environments like that. And that's another reason why I think you ought to see a lot more women in this business. And then the question, I think, really is why you don't. And I think that's because of a fundamental misunderstanding. This is not a mathematical business. I mean, people tend to think this is a financial business. It's all about mathematics. If you look at that formula for basically the return, which is the cash return, the organic growth return, the active reinvestment return, and the fade rate, all you're doing is adding, subtracting, multiplying, and dividing. It's linear in those elements. So if you can add, subtract, multiply, and divide with a calculator, because we do have those nowadays, and you can think clearly in a disciplined way, this is a terrific field for you. And that's why I think that this is a field where I think women are going to do especially well, and focusing on recruiting them and focusing on what you're doing with that is particularly important.
And I also think, Bruce, I'd like to add on that point too, the having the discipline and the temperament and the clear fundamental smarts, it all is what this business is about. And so, if you're in a different, come with a different perspective or are in a different demographic group, the biases that would exist from a boss or otherwise are somewhat taken away because performance speaks for itself too. So I think some environments in the workplace are hard for some populations because they don't see senior people like them advocating for them or mentoring for them. But if you're good at this and you found the right profession for you, it really doesn't matter what you look like or who you are, as long as you're
absolutely. But I would just do one caution. Diversity does matter, but there are a lot of stupid opinions that are diverse. So when the engineers at Chernobyl decided they were going to run their own experiment, you could say, aha, creative diversity. But there are contexts, and I think especially in investing where lots of money is at stake, where you have to be careful about a certain kind of diversity, trying to be the smartest person in the world. Now, I think that is not a kind of diversity, disagreeing with everybody, that women are particularly prone to. So I think the points that you've just made are really important. But I just, for managers or people you're giving your money to, people who say, I think outside the box, 80% of the time, that's going to be wrong.
Yes, right. Not to be contrarian for contrarian's
sake. Exactly.
Yeah, I couldn't agree with you more, Bruce. Well, I mean, I'm very excited about this edition. It finally puts to print a lot of the things that you've been teaching for years in the classroom as franchises and technology. You know, since I joined you in 2002, we saw the tech boom and we saw a lot, you know, the financial crisis and a lot of things go through. And I think this edition of the book copes with a lot of the changes that we've seen in the marketplace. So any other last comments or thoughts?
Well, all right. So I think one of the problems, and I think you were around when we were coping with this problem with the first book. I mean, I'm now going to reveal something that the publisher may not be happy with. We wanted to price this book at $100. This is not a book for amateur investors in the strict sense. I mean, it should be clear when we talk about specialization, if you're doing it 2 hours a day and the other, I mean, let's just even step back. Investing is a zero-sum game.
Yep.
Every time you buy a stock thinking it's a good idea, somebody is selling you that stock thinking that's a good idea, more or less. The average return for all investors, asset class by asset class, has to be the average return to that asset class because everybody owns everything. And you know, the derivatives, the short, uncovered shorts and so on, net out. There's a buyer and a seller. So if you're going to be in the upper half, somebody's got to be in the lower half. And imagine if you're doing it 2 hours a day and the other side of the trade is doing it 8 to 10 hours a day. You're not going to be a successful investor. So this is a book for people who are one of two kinds of people. The first is that they are professional investors. The second is that they're really interested in their investments and following their investments, but they're not going to do it themselves. They're going to pick managers. Well, this book should help them identify which managers seem to know what they're doing and which managers don't. But if you're going to do it part-time, I'm going to get on board with Buffett. Just do an index fund and minimize the transaction cost. So I think that is a lesson about, in a sense, who should not buy this book. But I think there are a lot of people who should.
Well, and I think the second half of the book, we have a class at Notre Dame called The Art of Investing that really is some of, you know, it's like the Legends of Value Investing class at Columbia that brings in a lot of luminaries in the investment community so that as our students, whether they go, you know, and half the students in that class are not business majors, so they can hear from really good business people and really good investors so that they ask good questions. They understand if they're going to do active management, select active managers, what a good active manager sounds like. And I think the second half of the book with the profiles of the investors is a good resource for that. So
absolutely. And I hope that the investors we decided to include embody the lessons in the book. Because the problem is there are a lot of really persuasive people who are not good investors.
Well, that's fair enough.
Hopefully they don't show up in the classes, but we probably should sneak one or two in so that the students learn to discriminate, but it's obviously not something that's easy to do.
Fair enough. Well, Bruce, this has been terrific. We really appreciate your time. Thanks so much for being here today. And we thank Barnes & Noble for doing this exclusive paperback edition of the book. So thanks.
All right, Erin, thank you.